Greetings from the Audible Local Ledger, a reading service for people who are blind or print disabled. My name's Eric, and I'll be reading you selections from Barron's magazine with an issue date of May 25th of 2026. We'll start with Up and Down Wall Street by Andy Serwer. SpaceX went up 1,000-fold, and you couldn't buy it. Tim Campbell, CEO of Ballygifford, that paradoxically venerable yet go-go Scottish investment house, is waxing eloquent about maybe his favorite stock in the entire universe. The opportunities for SpaceX are absolutely enormous, Campbell tells me. Are we going to be facing a world in 2 or 3 years' time where it makes perfect sense that incremental energy is provided by solar farms in space? It's perfectly possible. What does that mean in terms of the number of launches that SpaceX might be involved in? And that's before we talk about Starlink and all the rest of it. Campbell is certainly walking his talk. Ballygifford owns over $4 billion of SpaceX, out of $260 billion of assets under management, a position the firm began building in 2018, a good bit of which is now up 19-fold, based on a $1.25 trillion valuation. That's quite the moonshot, and exactly what one hopes for in a growth stock manager. One wrinkle is that SpaceX has been private, and Ballygifford, which used to invest primarily in public stocks, is 40% invested in private companies in some of its flagship funds. Now, finally, SpaceX and the two big artificial intelligence plays, Anthropic and OpenAI, are in various stages of polishing up their prospectuses and going public. They are gargantuan stocks, each worth more than American Express, Qualcomm, and PepsiCo combined, with the SpaceX initial public offering looking to eclipse the previous biggest by orders of magnitude. Those three mega-privates aren't alone, though they do skew the data. PitchBook reports that the global unicorn universe hit 1,680 companies with an $8.6 trillion aggregate valuation in Q1 of 2026. But the top 10 by valuation hold 41.3% of that value. True, $8.6 trillion is about 5.5% of the total value of global equities, $157.3 trillion. But it's certainly where the action is, just as Ballygifford. By now, you're probably tired of all the tisk-tisking over valuations of these unicorn the stallion companies. Are they worth the $1 trillion or so that Mr. Market says they are? Who the heck knows? But it's also besides the point. The real rub here is that, generally speaking, neither me nor you, nor a dog named Boo, has been able to ride the incredible run-ups these companies have enjoyed. But venture capitalists and institutional investors certainly have. While you've been shut out, they've made aircraft carrier loads of money. And that's just wrong. Taking a step back and looking at IPOs in public equity markets versus privates, I think it's fair to say somewhere along the line we've lost our way. An IPO used to mark the beginning of an investable company's life cycle. Now it's a sign of middle age. The movie's half over. Much of the high-octane growth is gone. The sweet juice has been squeezed. Oh, sure, you can try to invest in these companies pre-IPO, including in platforms like Forge Global, owned by Charles Schwab, or NASDAQ Private Market, or in funds that invest directly in private shares, or special-purpose vehicles like Destiny Tech 100 and the ARK Venture Fund, or exchange-traded funds such as Tema Space Innovators. The problem, like Crazy Eddie for those that remember him, the fees are insane, says institutional investor Michael Weinberg, an adjunct professor at Columbia Business School. The good professor says his inbox is flooded with examples of this, like one investment with a 10% annual fee and a 10% upfront fee, or another with a 5% fee to get in, 5% to get out, and a 1 to 2% one-time fee. On May 1st of 1975, the Securities and Exchange Commission eliminated fixed-rate brokerage commissions. The costs of trading public stocks have declined ever since. Today, they're next to nothing. Now you want to buy some of the world's hottest growth stocks? It's back to 1975. According to Fidelity documents, the firm has greatly expanded its private investing operations over the past 15 years and now has private markets portfolio of $44 billion. As of year-end, its $299 million Fidelity Venture Capital Fund I's biggest holdings were a $34.6 million stake in Anthropic and a $47.7 million slug of SpaceX, the latter via the TCP Exploration Fund 2025. Fidelity is now looking to raise $750 million in its Fidelity Venture Growth Fund 2 for qualified investors. Minimum investment, $250,000 with a 3% annual fee for a 5-year investment period with no early redemptions and a K-1 for tax reporting. Fidelity declined to comment on its private markets funds. Fidelity's name gives me comfort, and its fees may be lower than others, but it's all a far cry from buying one of its actively managed equity funds, with fees typically less than 1%, never mind 100 shares of NVIDIA. The institutional side has its own foibles. It's a frenzy and it's frothy, says one institutional trader. Anthropic is doing a $30 billion tender offer at a $900 billion valuation, and they say you got to have it signed by Wednesday and funded by Friday or you're out. Everybody's trying to get in, or an existing investor gets a new allocation. He creates a special purpose vehicle and offers shares to his limited partners, but outside the fund, because the fund has got a fixed amount of money raised, and he puts 1.75% with a 20% carry on it. On Friday, someone asked if I could help him place $200 million of Anthropic. And then on Sunday night, the guy called back and said, forget it, it's all gone. It's the effing wild, wild west. We're tired of being Charlie Brown and Lucy with the football. This stuff falls apart at the 25th hour, and everybody accuses everybody because it's a private company. It screams for regulation. Above a certain threshold, the SEC should create a structure of best practices. How did it used to be? Take a look at the Magnificent Seven. When those companies went public, valuations ranged from $340 million for NVIDIA in 1999 to $81.2 billion for Meta Platforms, then Facebook, in 2012. Even adjusting for inflation, Meta's IPO value would be $117 billion. Less than 10% of SpaceX's valuation. The average time between founding and going public for the Mag 7 was 6.4 years. True, Anthropic is 5 years old, but OpenAI and Stripe were founded over a decade ago, and SpaceX back in 2002. If SpaceX, OpenAI et al. Went public years ago and you didn't buy, you might have still benefited if you owned the Invesco QQQ Trust or an S&P 500 index fund, as those stocks would probably have been included. SpaceX crossed the $1 billion valuation threshold in December of 2012. From there, it's up 1,000-fold, and no average investor could get in. Companies stay private longer because so much capital is flooded into them. Venture capitalists also insist that laws like Dodd-Frank, the co-author of which Barney Frank died Wednesday, and other regulations have made being public onerous. It's unclear whether the Trump administration's proposal to reduce reporting requirements from quarterly to semi-annually is a solution. It would be really nice to have more investors have access to these great companies by bringing them public, Adina Friedman, CEO of NASDAQ, tells me. We've been on a journey with the government to think about how to make IPOs great again. She describes various reforms like the timing of financial disclosures and proxy and litigation reform. Behind the scenes, NASDAQ has readied a cozy stable for unicorns to go public on its exchange rather than the New York Stock Exchange. As my colleague Bill Alpert points out, new rules allow large companies to become part of the NASDAQ 100, which serves as the benchmark for over $1 trillion in index funds, such as the Invesco QQQ, in 15 days instead of waiting up to a year. The rules also eliminate the index's requirement that a minimum of 10% of a company's issued shares be free trading. Recently, before SpaceX announced it was listing on NASDAQ, Friedman shared her space bona fides with me. When I grew up, for a while I wanted to be an astronaut, she said. Ground control to Elon must have worked. Now let's hope there's still some trajectory left for regular investors. College graduation speeches often reflect the mood of society and the institutions themselves. It isn't surprising, then, that business leaders speaking at commencements are bumping into some AI agita. Eric Schmidt, former CEO of Google, was booed at the University of Arizona for extolling AI, as was a real estate executive at the University of Central Florida. At Glendale Community College, also in Arizona, graduate names were reportedly botched by an AI reader that replaced human announcers. More booing. The Sunda Brown Duckett, president and CEO of TIAA, spoke of AI at Delaware State University, if less overtly. Your competitive advantage isn't what you know today, but your ability to keep learning, to adapt, and to lead through uncertainty, she said. No blowback there. Ed Bastian, CEO of Delta Airlines, earned applause, telling graduates at Emory University that he had AI write a speech, but tore it up because he noticed the lack of soul nor warmth. But NVIDIA's Jensen Huang talked up AI at Carnegie Mellon University, and the students were fine with it. Must be school dependent. Bet on graduates at Stanford being copacetic with Google CEO Sundar Pichai when he speaks on June 14th if he delves into AI, though some may seek jobs at Duke University. Microsoft Chief Financial Officer at Duke University, Amy Hood, spoke about her journey after graduating in 1995. You'll figure it out one messy step at a time, Hood said, and trust me, the mess is where all the good stuff happens. Meanwhile, Ray Dalio, founder of hedge fund Bridgewater Associates, spoke at his alma mater, Long Island University, 55 years after graduating, about how meditation changed his life. As a graduation gift to those who want it, I'm going to give you lessons on transcendental meditation. The most valuable gift I can give anyone, he said. Who knew chilling out brings success on Wall Street? Then there's the wisdom of Henry the Fonz Winkler, speaking at his alma mater, Emerson College in Boston. I live by two words, tenacity and gratitude, he said. Tenacity will get you where you want to go, and gratitude will make you enjoy the journey, no matter how bumpy. Correct amundo. Next up, the Streetwise column, authored by Jack Huff. Grand Theft Auto 6 is coming. Is Take-Two stock a steal? Has it really been 25 years since I stole a Mr. Whoopi ice cream truck, rigged it with a bomb, parked it near the docks, and played the jingle to lure rival gang members to murderous dairy-based doom? Like they say, enjoy it while you're young. Back then, I had time for occasional Grand Theft Auto, or more specifically, Grand Theft Auto 3, a landmark video game from Take-Two Interactive Software. GTA 1 and 2 in the late 1990s were much simpler, two-dimensional affairs with a top-down perspective. Take-Two bought the studio behind those, and then created Rockstar Games to develop edgy cinematic titles. GTA 3 in 2001 was a naughty revelation. First-person, three-dimensional, open world of beauty and barbarity. I did things with a rocket launcher and flamethrower that I'm still not proud of. Apologies to the entire Liberty City Police Department. But I also sometimes pulled over my Banshee sports coupe just to admire the sunset, even when I had a 4-star wanted level while I ran so far away by a flock of seagulls played on Flashback 95.6. GTA 3 was transformative for Take-Two shares. In the month leading up to the game's launch, they had dipped below $5 split adjusted. 2 decades later, they were at $180, and shareholders had done more than 4 times as well as the S&P 500 index. But over the past 5 years, the stock is disappointed, gaining only 28%, while the S&P made 90%, including dividends. I didn't keep up with the franchise. Somewhere around GTA 4, I got married, and before long, I was immersed in an even more chaotic open-worlder called parenting. But now I hear that after much delay, a new installment, GTA 6, looks likely to ship in November. And this one seems particularly significant for the struggling stock. GTA releases used to come fast and furious, you might say, nearly one a year, counting major and minor titles over the first decade after going 3D. Then, after a few quiet years, GTA 5 launched in 2013, which added a multiplayer mode, now available separately as GTA Online. And there hasn't been a new version in the 13 years since. That's because the online game operates as a continuous moneymaker, like Roblox or Fortnite. New players buy the game, spend on in-game currency to obtain special vehicles, apartments, weapons, and what have you, and they pay for monthly memberships for other perks. Revenue over the past 13 years has multiplied, and growth has gotten smoother. There are good reasons now for a new release. Modernizing the mapping technology will allow for bigger worlds with better artificial intelligence and physics. A new monetization system would allow Take-Two to draw closer to the lucrative Roblox model of allowing players to create and profit from content in exchange for a cut. Plus, fans of the series want a new single-player storyline, and giving them one will boost upfront game sales. GTA 6 was originally slated to launch last year, but has been delayed multiple times. This past Thursday, its fiscal fourth quarter report, management stuck by its latest plan to release the game November 19th. Recent results topped Wall Street forecasts on strength from GTA Online, NBA 2K, and Zynga, a giant in casual phone games that Take-Two acquired in 2022, and Red Dead Redemption 2, a cowboy shoot-'em-up first released in 2018 and still earning nicely online. Guidance for the year ahead fell short of estimates. That is a Take-Two signature. For its recently completed fiscal year, management had first forecasted 5% bookings growth, but it delivered 19%. Bookings include product sales, along with money collected for service not yet delivered, like in-game currency purchases. For the year ahead, the midpoint of company guidance implies about 20% bookings growth. Take-Two shares aren't obviously cheap, at just over 50 times projected earnings for the company's fiscal year through March 2027. But earnings have recently been depressed by high development costs for GTA 6 without corresponding revenue, so Take-Two is expected to triple its earnings per share in 4 years. Overall yearly spending on console games has more than doubled since GTA 5 came out to nearly $40 billion estimated for this year. If GTA can capture the same 10% of the market now that it did then, Wall Street estimates could prove low. UBS, which is bullish on Take-Two, notes that its survey points to significant pent-up demand for the new GTA, that sales-boosting social effects online are greater today than in 2013, and that the release date is well-timed for Christmas shopping. It sees scarcity value in shares. Electronic Arts is being taken private in a deal valued at 19 times forward earnings before EBITDA, and Activision was bought by Microsoft at 18 times. That leaves Take-Two trading at 16 times UBS's EBITDA forecast for the fiscal year ending March 2028 as the last U.S. developer of big-budget games. Morgan Stanley, also bullish on the stock, notes that historically video game publisher stocks have risen an average of 18% over the 6 months prior to highly anticipated launches, and that the peak has actually tended to occur a month before launch at a 26% gain. I wish I could say that I'll report back after playing GTA 6, but something tells me I'm still on flamethrower sabbatical. When I saw that the game is set in Vice City, based loosely on Miami, whereas back in my GTA 3 days Liberty City was more like New York, my first thoughts were about all the money that move would save me in state taxes. Those probably aren't the instincts of a man who's ready for a return to carefree video game criminality. Moving on in the Barrons of May 25th, a little bit about what happened last week and a forecast of what is to happen this week. Last week in markets, inflation was back on investors' minds as the week began, with government bonds selling off around the world and yields surging. 30-year Treasury yields hit highs not seen since 2007. President Trump threatened to bomb Iran, then said he's holding off as Persian Gulf allies pursue talks. Oil prices fell. Stocks sank, then soared as yields eased on Wednesday ahead of Nvidia earnings. The S&P 500 index saw its 8th straight week of gains, and the Dow Industrials hit a record high on $2 billion in federal incentives for 9 quantum computing companies. On the week, the Dow was up 2.1%, the S&P 0.9%, and the Nasdaq Composite 0.5%. In companies, Nvidia had another record quarter, beating on earnings and guidance, but shares fell. SpaceX filed for its initial public offering under the ticker SPCX, seeking to raise over $75 billion, easily the biggest ever. Goldman Sachs leads the underwriting. A jury decided that Elon Musk waited too long to sue OpenAI for going commercial and tossed the case, clearing the way for an OpenAI IPO. Musk said he'll appeal. Alphabet's Google and Blackstone agreed to set up an artificial intelligence cloud group. In deals last week, Florida's Next Era Energy agreed to acquire Virginia's Dominion Energy in a roughly $67 billion all-stock deal, the biggest merger tie-up this year so far. The deal creates the world's largest regulated utility. Estée Lauder and Spain's Puig brands ended merger talks. And in this week, on Monday, May 25th, Memorial Day, equity and bond markets are closed in observance of the holiday. On Tuesday, May 26th, Agilent Technologies, HP Inc., Marvell, the Conference Board, releases its Consumer Confidence Index for May. Consensus estimate is for a 92 reading, roughly 1 point less than in April. Consumer sentiment remains near 5-year lows despite a record-high stock market. Wednesday, on May 27th, Technology and Salesforce report quarterly results on Wednesday, followed by Costco Wholesale and Dell Technologies on Thursday. On Thursday, May 28th, the Bureau of Economic Analysis releases the Personal Consumption Expenditures Price Index for April. Economists forecast a 3.8% year-over-year increase, 0.3 of a percentage point more than in March. The core PCE price index, which excludes volatile food and energy prices, is expected to rise 3.3%, compared with 3.2% previously. If those estimates prove correct, it'd be the highest annual change since May 2023 for the PCE price index and October of 2023 for the core PCE. By the numbers, 1.3 billion is the rise in Africa's population since 1950. Africa is the only world region with fertility above replacement rate. $45 billion. That's how much more Americans spent on gasoline and diesel during the Iran war than the same period a year earlier. 30% is the forecast for the percentage of 2026 global sales of electric vehicles and plug-in hybrid cars, from 25% in 2025. And 6.51% is the average rate on a 30-year fixed-rate mortgage this past week. That's the highest since last August's 6.56%. Our next story is titled, Bond Yields Are Heading Toward the Danger Zone. Inflation fears and deepening deficits have sent yields rising around the globe. Now rising long-term rates could put pressure on stocks. This is written by Randall W. Forsyth. Bond yields rose this month to levels that are setting off alarm bells across financial markets. The 30-year U.S. Treasury bond yield hit 5.2% on May 19th. It's the highest level since mid-2007, just before the 2008-2009 financial crisis. The 10-year yield topped 4.68% the same day before retreating, but remains above 4.5%. The trend is global, Yields on United Kingdom gilts, German bunds, and Japanese government bonds have also been climbing, in tandem with a rise in crude oil prices since the Iran war began in late February. But these are just the latest moves in a sustained rise in yields that's been underway since long-term interest rates bottomed at historic lows in 2020, during the worst of the COVID pandemic. What is different this time is that long-term interest rates have reached levels that could put pressure on equity valuations. Major stock indexes are just below historic highs, reflecting investor enthusiasm about artificial intelligence plays, which could reach a fever pitch as some of the biggest AI developers prepare to come public. Higher bond yields provide competition for stocks and raise corporate borrowing costs. The proximate cause of the recent bond rout, bond prices move inversely to yields, is the rise in oil prices due to the continuing closure of the Strait of Hormuz, a critical energy shipping waterway in the Middle East. West Texas Intermediate, the U.S. benchmark crude, nearly doubled to just shy of $113 a barrel on April 7th from about $67 a barrel on February 27th, the day before the war began. Crude prices have since retreated to the low 100s, but even at lower levels, they're creating inflationary pressures that may not dissipate soon. Robin Brooks, senior fellow at the Brookings Institution and former chief economist at the Institute for International Finance, cites 3 reasons for the rise in bond yields, which has lifted the 10-year Treasury yield from about 0.5% in 2020. Governments almost everywhere went on an emergency borrowing binge to counter the economic impact of the pandemic. There's been no meaningful reduction in deficits since then, and inflation has remained higher and more volatile than in the years preceding COVID. Total U.S. federal debt held by the public topped 100% of gross domestic product in this year's first quarter, approaching the record of 106% after World War II. The Congressional Budget Office estimates that the budget deficit will total 5.8% of GDP in 2026. More important is the future trajectory. The CBO estimates that the U.S. budget deficit will average 6.1% of GDP annually over the entire decade through 2036, far higher than the 3.8% average of the past 50 years. A fraught geopolitical environment is pushing up military spending, which means many countries may have to issue still more debt. Buyers are likely to demand even higher yields. The Trump administration is seeking a 44% jump in military expenditure for fiscal 2027 to a record $1.5 trillion. Other countries, notably America's European allies and Canada, boosted their military spending by more than 20% in 2025, and they pledged to scale up military and security-related expenditure to 5% of GDP by 2035. An even bigger burden on budgets is the seemingly intractable increase in interest expense from the past borrowing binge. Interest expense is running at more than $1 trillion annually in the U.S., topping current military outlays for now. As for inflation, it's fallen from recent peak levels in 2022, but remains elevated and volatile. As a result, central banks have had to implement more frequent and larger hikes in short-term interest rates to contain expectations for future inflation. The futures market now sees a 70% chance of a Federal Reserve rate hike of at least a 1/4 percentage point by December, according to the CME FedWatch tool. That marks a notable change from prior expectations of more than 2/4 point cuts by the Fed by year end. J.P. Morgan economists look for the European Central Bank and the Bank of Japan to raise their policy rates in June, with a possible hike from the Bank of England. When government borrowing costs top the growth of nominal GDP, or an economy measured in current dollars, including inflation, that's another danger signal, say Brown Brothers Harriman's currency analysts. That's already happened in the UK, with a 10-year gilt yielding nearly 5% above annual 10-year nominal GDP growth of about 4.8%. Even more perilous is the crossover in Japan, where the 10-year government yield has soared to more than 2.5%, the highest level since mid-1997, after years of artificially suppressed interest rates there. Japan's 10-year average annual nominal GDP growth is 1.9%. What happens in overseas bond markets doesn't stay there, however. For years, foreign investors, starved for yield at home, exported capital into U.S. Treasuries, stated a recent Yardeni research note. As domestic yields abroad rise, that incentive weakens. The U.S. government must compete for buyers of its debt on its own merits in a world of high government deficits and rising inflation. The U.S. Treasury has attempted to limit its interest costs by twisting its borrowing toward short-term bills and away from intermediate and long-term notes and bonds, which carry higher yields. That ploy, initiated in 2022 by former Treasury Secretary Janet Yellen, was criticized then by now U.S. Treasury Secretary Scott Bessent, who nonetheless continued it as her successor. The practice worked in Uncle Sam's favor as the Fed lowered its short-term interest rate target by 1.75 percentage points in 2024 and 2025, but it may backfire if the central bank starts hiking. In the near term, bond yields will continue to be driven by progress or lack thereof in resolving the Iran war and reopening the Strait of Hormuz. Given the proximity of the U.S. midterm elections and the importance of gasoline prices to voters, markets have priced in a reversal in the rise of oil. But even if that comes to pass, inflation, excluding food and energy, remains sticky, notably for services. Longer term, the debt overhang will remain throughout the developed markets. There's little prospect of governments reining it in while they borrow to fund domestic spending and ramp up military expenditure. Plus, the AI spending boom will add to corporate borrowing. Reflecting these trends, 62% of respondents to Bank of America's most recent fund manager survey indicate they anticipate the 30-year Treasury yield will top 6% in the next 12 months. That sort of surge would almost certainly send stocks reeling, which could make for a rally in bonds, but it would be short-lived. The next headline: Inflation stings bonds, with one exception. Treasury inflation-protected securities are generating positive returns despite a rough bond market, by Andrew Barry. Inflation is rising, bond prices are falling, and tips are having their moment. The prospect of a protracted period of elevated inflation, stemming from higher oil prices and other factors, heightens the appeal of Treasury inflation-protected securities. Tips. Tips are among the only bonds that can insulate investors from higher inflation. While most bonds have dropped in price this year, tips have generated positive returns, and they remain attractively priced. Tips are, I think, perhaps one of the most underappreciated and underutilized investments. It's like a treasury, but it has an inflation hedge. Alex Shahidi, managing partner and co-chief investment officer of LA-based Evoke Advisors, told Barron's advisor. Not enough individual investors and financial advisors include tips in their bond allocations. It's been a rocky period for the bond market, with 10-year treasuries recently hitting a yield of almost 4.7%, their highest since January of 2025. Bond prices go down when yields go up. Tips are like insurance, offering investor protection against higher inflation. The yield on tips has two components. The bonds pay investors the inflation rate, as measured by U.S. consumer prices, plus a bonus, or real, yield above inflation that ranges from 1 to almost 3 percentage points, depending on maturity. Here's the calculus for someone considering a 10-year Treasury investment. The regular Treasury 10-year note yields 4.6%, while 10-year tips have a real yield of 2.15%. That means inflation has to run at more than 2.45%, 4.6% minus 2.15%, for tips to be the superior investment over the next 10 years. Well, that sounds like a good bet. April consumer prices rose 0.6% from March, and at 3.8% over the prior 12 months. Analysts see a good chance of 3% plus inflation for the rest of 2026, above the Federal Reserve's target of 2%. And then there's the insurance aspect. Tips effectively provide insurance against higher inflation, while regular treasuries and most bonds don't. Long-term TIPS have the highest yields and offer an appealing standalone investment. The real yield of almost 3% on 30-year TIPS is near a high in the nearly 30 years of TIPS issuance. Pension funds, endowments, and other tax-exempt portfolios often try to generate annual returns over time that are at least 5 points higher than inflation and make risky investments such as private equity to try to achieve that. Investors can effectively get something close to that, a 3% real yield on treasuries with no risk. This assumes the government doesn't default. The break-even inflation rate on 30-year TIPS is just 2.3%, enhancing their appeal. With 30-year TIPS now yielding almost 3% real, investors can now lock in inflation-adjusted returns that are competitive with traditional portfolios without the risks that come from a large slug of equities, wrote Bob Elliott, CIO of Unlimited Fund and a former Bridgewater Associates manager on X last week. Most investors focus on shorter maturity TIPS due in 10 years or less. They offer inflation protection and carry less price risk than long-term issues. What are the risks with TIPS? If inflation cools, demand may ease, and TIPS could underperform U.S. Treasuries. And if inflation does move much higher, TIPS probably will best regular Treasuries, but they still could generate negative returns. There are more than $2 trillion of TIPS outstanding, and investors can buy them in several ways. They can be purchased directly from the Treasury at regular auctions of TIPS of bonds with 5-year, 10-year, and 30-year maturities. They can be bought in the secondary market through banks and brokers. The Treasury auctioned 10-year TIPS this in mid-May and plans to sell 5-year TIPS in June. Funds, particularly low-fee exchange-traded funds from a range of issuers, offer a good alternative to individual bonds by simplifying some of ownership mechanics. The 4 largest TIPS ETFs are the $18 billion Vanguard short-term inflation-protected securities, the Schwab U.S. TIPS, the iShares 0 to 5-year TIPS bond, and the iShare TIPS bond. The final 3 funds are each about $15 billion in size. The fees are low, including just 0.03% on the iShares 0 to 5-year TIPS ETF, the Vanguard ETF, and the Schwab TIPS ETF. Investors can create a maturity ladder of TIPS, and iShares simplifies that with iShares iBonds 1 through 5-year TIPS Ladder ETF. The tipsladder.com website gives you the bond details to construct your own ladder. Vanguard includes TIPS in some of its shorter-dated target date mutual funds geared toward investors around retirement age. There are some quirky aspects to TIPS. The inflation component of the yield is added to the principal every 6 months, and the real rate is paid in cash. This results in a phantom income issue because investors owe federal income taxes on the inflation component, and they get no cash. The ETFs pay out that inflation-related interest, avoiding this issue. Another way to buy inflation-protected treasuries is through Series 1 U.S. savings bonds that are offered through the Treasury.gov website. They now offer a yield of nearly a percentage point above inflation. The current rate, lasting through the end of October, is 4.26%. The rate gets reset every 6 months based on the Consumer Price Index inflation figure. With certain exceptions, investors are limited to $10,000 a year in one bond purchases. With inflation heading higher, TIPS are an underappreciated and underowned asset class that merits greater attention from investors. We'll move to the cover story. Mega IPOs. Buy at your own risk. The largest U.S. IPOs tend to underperform, with some shedding value for months, even years. This is written by Nate Wolf. In a bygone era, an initial public offering was a way for investors to get in on the ground floor of a promising company. In 2026, it's more like parachuting onto the roof. When SpaceX goes public in June, the company's likely to carry a valuation approaching $2 trillion. It'll probably raise a record $75 billion in the deal. CEO Elon Musk may become humanity's first trillionaire. We're way past startup. Thanks to a seemingly bottomless pool of funding, the most exciting companies can stay private for longer and then go public at dizzying valuations. Artificial intelligence rivals Anthropic and OpenAI, data platform Databricks, and payment processor Stripe are all candidates for so-called mega IPOs, at valuations of $100 billion or more if SpaceX's offering goes well. Bigger isn't necessarily better, though. Historical data show that the largest U.S. IPOs tend to underperform the market, with a not insignificant share of those stocks delivering negative returns. And the coming wave of mega IPOs presents more risks than usual. Private investors are licking their chops at the prospect of cashing in on long-awaited gains. Even the savviest, most battle-tested investors may fear missing out. But SpaceX and its fellow IPOs won't behave like normal stocks for months, if not longer, and trading promises to be choppy and unpredictable. Waiting out the chaos may not be exciting, it will be shrewd. Facebook, now Meta Platforms, still holds the record for being the most highly valued U.S. company at the time of its IPO, with a market cap of $81 billion in May of 2012. SpaceX could come public at more than 20 times that size, even larger than Meta is today. The AI labs, meanwhile, are still conducting 12-figure private funding rounds of their own. OpenAI secured $122 billion at an $852 billion valuation in late March. Anthropic one-upped its rival the next month, fielding proposals from investors that would value it at as much as $900 billion, according to multiple reports. Saudi Aramco is the lone historical corollary for IPOs of that size. It went public on Saudi Arabia's stock exchange in 2019 at a valuation of $1.7 trillion. The only company that's done something at this scale was a state-funded oil company in one of the less transparent markets in the world, says Avery Marquez, Director of Investment Strategies at IPO research firm and fund sponsor Renaissance Capital. There is really no relative scale. The record of the very largest IPOs is spotty at best. Excluding Cerebrus Systems, the chip maker that completed its IPO a few weeks ago, 36 U.S. companies have gone public on a U.S. exchange with a market cap of $15 billion or more, according to FactSet. Only 9 have beaten the S&P 500 index's returns from their first-day closing price. Just 17 have generated positive returns at all. Look down the list of winners, you'll see tech luminaries like Google, now known as Alphabet, plus 15,500%, and Palantir Technologies, plus 1,347%. But for every Google, there's a Lyft, minus 83%, and for every Palantir, there's a UiPath, minus 85%. Some of the companies, such as telecom equipment maker Lucent Technologies and smartphone precursor Palm, have all but disappeared. However you slice the data, narrowing in on tech companies, expanding to IPOs of any size, excluding the dot-com bubble, you'll notice a pattern. On average, stocks spike on their first trading day, but they struggle to keep up the momentum over time. The 1,724 U.S. IPOs from 2011 through 2024 had an average first-day pop of 23%, according to data from Jay Ritter, a University of Florida professor dubbed Mr. IPO. Over the next 3 years, the newcomers lagged behind the market by 25 percentage points. The trends are especially rough for companies that trade at a high premium to their revenue, suggesting big expectations for growth. Since 1980, issuers with trailing annual sales of at least $100 million and a price-to-sales ratio above 40 have seen an average 3-year drop of 45% from their first day's close. SpaceX will be the next name in that data set. At an estimated market cap of $1.8 trillion, the company would trade at 93 times trailing sales. I think there's a very good chance that these IPOs will jump on the first day of trading, Ritter says. And whether they go up or not, one thing that I'm certain about is the stock is going to be very volatile. Don't expect the data to spook investors, many of whom have been waiting for years to invest in SpaceX. In fact, there are plenty of reasons to expect yet another explosive first-day gain in June. To start, the hard numbers are genuinely impressive. SpaceX accounts for the majority of all orbital launches worldwide, and its use of recycled rockets has driven per-launch costs well below what the sector ever thought was possible. Starlink, its satellite broadband system, served 10.3 million customers by the end of March, generating profit margins on earnings before interest, taxes, depreciation, and amortization, or EBITDA, of 63% on $11.4 billion in revenue in 2025. And if innovative telecom business is the floor for SpaceX stock, putting solar-powered data centers in space represents the stratosphere. Like many of Musk's ideas, orbital AI seems straight out of a sci-fi novel, but the company's already attracting serious partners like Alphabet and Anthropic. At a time when data center developers are scrambling for power and land, SpaceX is offering to eliminate the need for both. The AI business, SpaceX says in its IPO prospectus, has a total addressable market of $26.5 trillion, nearly as large as the entire U.S. gross domestic product of $31.9 trillion. And then there's the hype. SpaceX has been the most famous private company in the world, attached to one of the most polarizing public figures alive, and inaccessible to most investors for 2 decades, explains Jake Miller, co-founder of Opto, a tech platform for private investing. That's a generational IPO story. It's not a normal one. For now, it's also an unprofitable one. In the first quarter of 2026 alone, the company reported a $1.9 billion operating loss, driven by a $2.5 billion loss in the AI segment. SpaceX didn't respond to Barron's request for comment. By all accounts, investors are pining for shares. SpaceX has yet to declare the size of its IPO offering, but it'll probably be a single-digit percentage of the company's total shares outstanding. The company plans to set aside much of that for retail investors, including those with accounts at Charles Schwab, Fidelity, Robinhood, and SoFi. The retail focus makes sense given Musk's unique pull among a certain set of self-directed traders, according to Marquez, who expects retail demand to be strong. One bracket higher, some high net worth investors are pitching the stock to their advisors, rather than the other way around. In all my years in this business, I've never had so many inbound inquiries on an IPO like this, says Drew Frieds, a UBS private wealth advisor who's optimistic about SpaceX in the long term, but wants to see the valuation before recommending the stock to clients. We spend a lot of time, reining in clients and just being cautious. OpenAI and Anthropic were no less famous or exciting. The pair are locked in a warp-speed race to build the future of human technology, and they're starting to generate significant cash. Anthropic said in May that it had hit a $30 billion annualized revenue run rate. Earlier this year, OpenAI said its run rate had exceeded $20 billion. Both companies declined to comment for this article. The Wall Street Journal reported last week that OpenAI is preparing to file a confidential IPO prospectus with regulators in the coming days. There are reasons for the pair to go public soon, particularly if SpaceX's IPO is a success. Training and running AI models is expensive, and the two companies are in constant need of capital. Public companies can use their stock to quickly open the financing spigot. Competition for capital, a record valuation, or good old-fashioned bragging rights is the other factor. There are no public AI companies, says Harrison Rolfs, a research analyst at PitchBook. Whoever IPOs first becomes the market leader. The real winner of a mega IPO isn't necessarily the company or public investors, though. Private investors are the ones coming out on top. Following the financial crisis, legislators designed the 2012 Jumpstart Our Business Startups Act to stimulate public markets. But the law also eased the path for private offerings by allowing larger companies to keep their financials private. Under the Jobs Act, the threshold for requiring disclosure went from 500 shareholders to 2,000. With less of a regulatory nudge, companies can soak up round after round of funding from investors looking for exponential returns. It helps that private markets are no longer the exclusive province of venture capital firms. Institutions, family offices, and high net worth individuals are all getting in on the action. Some investors have access through special purpose vehicles, a pooled secondary market investment that the companies themselves may not recognize as legitimate. If you pay close enough attention, you can find someone who can sell you some SpaceX, says Tom Kerr, co-head of investments at private markets investment firm Hamilton Lane. Kerr doesn't advise going that route. Early investors also often have astronomical gains on paper. SpaceX, for instance, was worth a measly $30.5 billion in 2018, but selling shares on the secondary market can get clunky. An IPO solves that problem, giving founders, employees, and other private shareholders an opportunity to sell shares at will. And make no mistake, investors will take at least some chips off the table. Companies are already stating as much publicly. The London-listed Edinburgh Worldwide Investment Trust, which has had a stake in SpaceX since 2018, said in April that it would propose a tender offer following the SpaceX IPO, allowing shareholders in the closed-end fund to crystallize their returns. On an earnings call in February, Cannae Holdings CEO Ryan Caswell said the investment firm's SpaceX stake seems like it'll be a source of cash for us over time. Lise Beyer, founder of IPO advisory firm Class V Group, says private market investors are under pressure to provide liquidity to clients. It's hard to go out and raise new funds if you haven't put any money back in the pockets of your previous investors. Others are exiting before the IPO even happens. Mark Lipschultz, co-CEO of embattled private equity firm Blue Owl Capital, told investors in April that the company had realized roughly 10 times returns by selling about half of its SpaceX investment at a $1.25 trillion valuation. To be sure, investors won't be able to dump shares right away. Private shareholders typically have a 6-month lockup period after an IPO, during which they're prohibited from selling. Issuers and their investment banks are increasingly engineering ways to reduce the cascade of stock at the 6-month mark. Cerebras shareholders, for instance, will get a chance to convert and sell 84 million Class B shares in August, and then another 87 million shares in September and October, all before 6 months pass in mid-November. SpaceX is getting similarly creative, with a portion of shares unlocking after the company's second and third quarter earnings report. Another batch unlocks if the stock price reaches certain levels. At some point, you're going to have a massive waterfall of stock that's going to be coming to market, says Ken Smythe, CEO of secondary investments firm Next Round Capital. How the company manages that is going to be critical, because there's never been this amount of unlock at one time. Retail trader personalities online have a warning for investors trying to buy from institutions. You are the exit liquidity. With mega IPOs, that exit liquidity will probably include the index funds held by pension funds and retirement accounts. NASDAQ rolled out a fast entry rule in May that shortened the waiting period for mega-cap stocks to be included in the NASDAQ 100 index to 15 trading days, down from as long as a year. S&P Dow Jones Indices has also proposed shortening its wait for S&P 500 inclusion to 6 months from 12 months. It could implement the rule just before SpaceX's IPO. Dozens of the world's most popular funds are linked to these indexes, and they will probably be forced to buy recent mega IPOs sooner than they would have before. This forced buying could create the demand that early investors need to unload shares, facilitating an enormous wealth transfer from private markets to public markets. The insider is going to be able to cash out at this inflated price, but the index funds are going to be buying at this inflated price, says Ben Schifrin, Director of Securities Policy at Better Markets, a consumer-focused advocacy group. That seems, not great for retail investors. On one hand, the automatic demand is helpful. If issuers like SpaceX can properly time lock-up expiries, they may be able to prevent huge sell-offs when new shares become available. On the other hand, markets are in uncharted territory when it comes to the sheer volume of stock changing hands. Investors trying to ride the coattails of funds by buying SpaceX just before it gets included in the NASDAQ 100 or the S&P 500 may find themselves in a crowded trade. Once you get past those index inclusions, well then where's the demand, says Jim Lebenthal, Chief Market Strategist at Cerity Partners. I suspect that these companies will have a very long, profitable future as public companies. But there might be a little hiccup in the shares after they're included in the indexes. It will be difficult to ignore the news when SpaceX starts trading in a few weeks. Those who don't buy the SpaceX IPO could easily get the SpaceX FOMO instead, as in fear of missing out. Friedis, the UBS advisor, says client inquiries are more about a fear of missing out and less about company fundamentals. They feel like I should have been in this thing years ago, and why aren't I in this, and how do I get in this? And I don't care what it costs. Resisting the urge to chase the stock is the prudent move. Investors should expect wild, unpredictable swings in the first several months of trading, without the venture capital-like upside they'd get from a smaller, younger company. SpaceX's future may even include merger with Tesla, further complicating the growth trajectory and stock upside. To those tempted by the mega IPOs, Lebenthal advises an admittedly old-fashioned approach: diversification and dollar-cost averaging. There are plenty of retail investors out there who are like, I want to move all my chips on to OpenAI. Good luck. I wouldn't do that, he says. You got some on the IPO? Okay, great. Save some dry powder for whatever may come next. IPOs the size of SpaceX, or indeed OpenAI and Anthropic, are essentially a new asset class altogether. Each quarter that passes after SpaceX's IPO will offer new data on how the asset behaves. Patient investors get the benefit of seeing more quarterly results and gauging SpaceX's progress toward justifying its valuation. Perhaps more importantly, they'll see how both hyper-driven investors and billion-dollar institutions react. Another argument for patience: investors who bought Meta after its first day of trading are up 1,474% today. Those who bought it 6 months later have booked gains of 2,454%. IPOs get treated like the main attraction. Just remember, the real investment story is what happens next. And with that, we've come to the end of our reading of Barron's magazine with an issue date of May 25th of 2026. This is your reader Eric saying be well, be safe, look after each other. Bye for now.